Time now for today's Market Movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio, and today we're discussing trade talks and their ramifications through currency markets. We're looking at using Canadian dollar options as a means of hedging risk or creating exposure to these highly volatile negotiations. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Scott, okay, so the Mexico trade agreement, what did it mean to risk assets and why? And what did it mean to currencies?
Well, gosh, if you look at the markets and those risk assets you talked about, Jim, it kind of opened the door for them to continue that run that they're on. And here's what I think is interesting about the trade deal with Mexico as it pertains to Canada. To me, it put a lot of pressure on Canada.
I think that's what it was designed to do. Right,
that's right.
Yeah.
Maybe even China down the road with respect to how those countries are now going to have to come to the table to answer what Mexico did.
So is the market's reaction to this just saying that this is a good deal, or is it about the ancillary factors like Canada being put in the corner? Perhaps it's a victory for Trump that bodes well for the elections.
It's funny you use the word markets because, as you know as well as I do, there's different parts of the market that will react differently in the sense of, yes, equities would tell you everything's a full go and these negotiations are going to work out. And maybe so in the currencies too, which we'll talk about in a second. But sometimes if you put those things together, look at currency, look at bonds, look at equities, and put them all together and see how they're all reacting as a whole, that maybe tells you how things are going to work out.
Before we dive into our trade discussions, I'd like to point out, with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products to either manage risk or create additional opportunities, not as recommendations or advice. Price and movements will vary. The SEP Canadian dollar, when we priced this out, was trading about $77.50. Scott.
Yeah, the Canadian dollar.
Canadian
crazy
dollar
thing. Once
rallied.
called the loonie, which I think is still fair to say. I think that's still fair game. The Canadian loonie, which is out there as a great way to kind of, I believe, kind of test the waters as far as how these negotiations are going to work out. So specifically, Jim, I think there's some interesting things in the chart here that are worth talking about and maybe taking advantage of. The week 2 September, 7750, 7800 call spread. It'll cost about 22 ticks to put on. It expires September 14th. 7750 or so is the underlying, so it risks 220 to make a potential 280. As I believe these tensions say wane a bit, they work off, and you start to see some of those currencies that have been trading against the dollar, trading negative because the dollar's been strong, as they start to reappreciate to back to levels where they should be.
I like it a lot. Are you saying that the Canadian dollar was punished when the trade talks heated up, and now that trade is unwinding, and that's why it's born?
Tossed. In fact, if you look at the charts in June, my goodness, major drawdown. And since that bottom in June, you have this nice upward sloping channel up and to the right that I believe takes that trade through that call spread.
I like what you're saying, and I might even like your trade better than the one I'm going to talk about, because there's two different things. One, that there should be some euphoria and the Canadian dollar go higher, but when the dust settles, perhaps it's better for our economy. Rates go up in our economy, appreciates our dollar, and
affects
may
our
caps,
currency. Good point.
And may caps the way the Canada's run. But I do think initially it should run. So I'm looking at buying the week 2 SEP, the same expiration as yours, the 7800, 7850 call spread for 14 ticks. So it's just 50 ticks higher than yours. Trade expires September 14th. You risk 140 to make a potential 360. So yours is more likely to happen. Mine is a greater payoff if it does.
Appreciation, yeah, which it's still the right direction, though, in my opinion. The question is, as we've talked about, now see, here's the thing I like about yours versus mine maybe, as far as the risk reward. You've got time on your side, too. I mean, we're both September 14th.
Yeah, 2
but
weeks.
Hey, that's a couple weeks now. It's not something that's a close expiry as we've done on some previous shows where you really got to manage that. Here's the other quick thing. The U.S. dollar has been one of those safe haven trades at times. So as things tend to work off, as cooler heads maybe prevail here, maybe that actually
Don't
trade
need as much.
down.
No, I like this, and it's very complicated. There's 3 different definite differences to looking at this trade. I'm curious to see which one wins out. Thanks for joining us on Market Movers. I'm Jim Urio, where we're helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.